Hello, I'm Greg Bonnell. Welcome to Market Call. David Burrows is on the show today. He's President and Chief Investment Strategist at Barometer Capital Management. Taking your calls, emails, tweets, and video questions on North American large caps. So give us a call, toll free, 1-855-326-6266. You can send an email to marketcall@bnn.ca or follow me on Twitter. Welcome back to the program, David. Always a pleasure to have you here.
It's great to be here.
All right, so usually in the summer we can turn off our minds to a certain degree and perhaps not get serious about the markets again until the fall. Been a different kind of a summer, though, particularly last week when we had to start worrying about the rhetoric between Washington and North Korea. How should investors be sort of riding out these storms that pop up every once in a while?
Well, okay, if you start by taking the lens back, we have a pretty strong belief that we have been in a secular bull market for equities that really got underway in 2013 when we took out the 2000 highs in the U.S. And so the backdrop is we probably have a pretty persistent rising market for quite a long period of time, of course with interruptions. We ended a correction in February of 2016, which probably opened the window to 2 to 3 years of pretty low volatility markets. And that's been the case, and that's been pretty consistent. Not without pullbacks, but 3 to 4% pullbacks. Seasonally, July, August, September, 3 toughest months of the year. Interesting, though, that the month of July, much better than seasonal. And historically, if July is good, then August and September less volatile than typical. And that has been the case so far. That doesn't mean you get no volatility. So we've seen over the last 3 to 4 weeks in equity markets around the world, the work that we do around risk has shown an uptick in risk as breadth, or the percentage of stocks doing well, has been deteriorating. Okay. So that always causes us to get a little bit more cautious, and we've been very bullish really since February of 16. So we have a little bit of cash in our portfolios currently. Frankly, I don't expect significant downside. I think that you could see over the next month or two, 3 to 5%. But given the fact that July was as strong as it was, and given the fact that the economic data is improving and the earnings have been very, very good, I wouldn't hold my breath and expect that kind of pullback, but I think it's possible.
I wanted to ask you, because we're basically, except for the banks on this side of the border, we've come out of the bulk of earnings season. Heading into earnings season, everyone said, all right, the American markets, are a little bit pricey. Did the earnings, in your mind, justify the PE ratios we're seeing?
Yeah, so what I think people don't fully understand is that not only are earnings beating, and this quarter was the best beat for both revenue and earnings since 2010, but earnings estimates are being revised higher. So when people talk about how expensive this market is relative to a long-term average, well, first of all, in a secular bull market, multiples should be getting more expensive as time goes by. Late in a bull market, they'll be very, very expensive. But revision should be going higher, and that's happening. So if the estimates are too low, then the PE isn't as high as everybody thinks. That's the first thing. Now, when we look at key risk measures, in a strong market, correlations, or the degree to which stocks behave the same, should be low. And we're at the lowest correlation we've been at 15 years. The excess return a corporate bond investor has to, demands versus what they could get in a sovereign bond, should be a relatively small spread. And we've seen no uptick in credit risk. And so when we look at the economic data and the earnings data, that's all supportive. So all of these things, I think, support the case that we're in a long-term bull market. It's going to go on for some time. But having said that, tactically, we get paid to manage risk, right? We have to generate a return, but manage the risk associated. In the very short run, I think that there's slightly elevated risk. North Korea wasn't the issue. Market was set up to have a little bit of volatility. And that happened to be the piece of news that got people's attention.
Excuse.
The breadth deterioration started well before the news last week, but markets handling news very, very well, and that's a really great indicator of the health of a market.
All right, we're going to be back with David Burrows. He is the President and Chief Investment Strategist at Barometer Capital Management. Answering your questions on North American large caps, give us a call. Toll free, 1-855-326-6266.